Are you ready to tackle the rising mortgage rates and what it means for multifamily real estate in Canada? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy Meyka. Let's get right to it. Mortgage interest rates in Canada are reaching new heights, marking a significant challenge for homebuyers across the nation. According to recent data, these rates are at their highest in over a decade, intensifying concerns around housing affordability in Canada. This surge is linked to the Bank of Canada's current outlook, indicating sustained high rates. For both first-time buyers and those renewing mortgages, the financial landscape is rapidly shifting. In October 2025, Canadian fixed mortgage rates have significantly increased, with many financial institutions reporting rates above 5%. This spike follows a series of rate hikes from the Bank of Canada aimed at curbing inflation. Higher mortgage costs are straining household budgets, especially for those seeking to purchase a home in the already competitive housing market. The fixed rates upward trend is unsettling prospective buyers who are now more cautious given the added costs. As these rates climb, affordability becomes a critical issue, influencing buying decisions nationwide. Looking at the Bank of Canada's rate outlook, experts forecast a sustained period of high interest rates. Earlier projections suggested possible rate reductions, but these are now delayed. The Bank of Canada aims to stabilize the economy by addressing inflation, but this strategy impacts mortgage holders heavily. Current forecasts indicate little to no rate cuts in the near future, leaving Canadian borrowers with little relief in sight. For those renewing their mortgages, budgeting for higher monthly payments is now a necessity. Housing affordability in Canada continues to be a pressing issue as mortgage interest rates rise. High borrowing costs add to the existing pressure from property prices, which remain elevated in urban areas. The affordability crisis is evident as more Canadians struggle to qualify for loans under stricter financial conditions. Investors and homebuyers must navigate this challenging environment, considering alternatives such as longer amortization periods or smaller properties to manage costs. In conclusion, the rise in mortgage interest rates in Canada signals a profound shift in the housing market landscape. As rates reach their highest in over 10 years, the impact on both new and renewing mortgage holders is significant. Home buyers are urged to reassess their financing strategies while keeping a close watch on the Bank of Canada's policies. Amid these challenges, tools like Meyka's AI-powered financial platform offer valuable insights and predictive analytics to help investors make informed decisions. Adapting to these changes with a strategic financial plan is crucial for navigating the current and future market conditions. In recent news, Canada has seen a significant surge in foreign investment, reaching a net inflow of $25.9 billion in August, the highest in over a year. However, this influx is not the usual positive signal it might seem. According to Statistics Canada, almost all of this investment was directed towards corporate debt rather than government bonds or equities. This shift suggests a nuanced perspective on the economic confidence in Canada. Interestingly, the demand for Canadian debt offerings reached $31.2 billion in August, the highest since April 2024. The majority of these investments, 58.5%, were in private corporate debt, a notable increase from 37.7% in April 2024. This indicates a growing confidence in the cash flow of Canadian corporations, but not necessarily in the broader economy. One of the most striking aspects of this investment trend is the preference for debt issued in United States dollars, nearly 10 times higher than Canadian dollar-issued bonds. This shows a strong vote of confidence in Canadian companies, but poses a challenge for the Bank of Canada. The weak demand for the Canadian dollar can undermine the effectiveness of monetary policy transmission, as rate cuts may not serve as a stimulus if companies rely on currencies issued by foreign banks. The report highlights that a significant portion of these U.S. dollar debt offerings came from just a few large issuers. First, Quantum Minerals, Brookfield, Gwazi Limited, and Denison Mines. These four companies accounted for over 21% of Canadian new issuance of U.S. dollar debt. This concentrated interest may point to selective investor confidence in specific firms rather than a broad-based confidence in the Canadian economy as a whole. In recent news, First Capital REIT has announced plans to reorganize its business structure by eliminating its real property subsidiary, First Capital Realty, and moving all of its assets into subsidiary partnerships and trusts. This strategic move, which has the unanimous support of First Capital REIT's Board of Trustees, is subject to a range of approvals, including a vote by its unit holders. A special meeting of unit holders is planned later this year to seek this approval. According to the announcement, the arrangement aims to simplify First Capital's operating structure and reduce the significant complexity inherent in the existing framework. This includes accounting, legal reporting, and income tax compliance. First Capital REIT focuses on owning, operating, and developing grocery-anchored open-air centers in neighborhoods with strong demographics across Canada. As of June 30th, the REIT held $9.4 billion in assets, with net debt just over $4 billion, representing 44.6% of total asset value. Notably, approximately 70% of its assets were unencumbered, according to its second quarter 2025 financial report. The proposal will not result in changes to First Capital's overall strategy, portfolio, or operations. After completing the arrangement, unit holders will continue to hold the same number and percentage of trust units as they previously held, and the REIT's units will remain listed on the Toronto Stock Exchange. The new structure will be implemented according to a plan of arrangement under the Business Corporations Act of Ontario and will require the approval of 66 2/3% of the votes cast by unit holders. First Capital's trustees and officers have expressed their intention to vote in favor of the arrangement. Management anticipates that the new structure will be in place by the end of 2025, pending all relevant approvals. This reorganization follows a period of public and at times contentious disputes with several investors, which led to changes in its board of trustees and a settlement agreement in March 2023. Despite past challenges, the trust stock has performed well recently, trading just below the $20 mark on the Toronto Stock Exchange. First Capital REIT's reorganization reflects a broader trend of companies seeking streamlined operations and improved financial efficiency. By focusing on its core strengths and simplifying its business model, First Capital aims to enhance its position in the competitive real estate market. As we monitor these developments, it's essential to consider how such strategic moves can influence the multifamily real estate landscape in Canada and beyond. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy Meyka. See you on the next one.